Lease accounting in India has undergone a major transformation with adoption of Ind AS 116. This standard has significantly impacted financial metrics for the companies across industries. But what does it mean for businesses? Let's break it down. Ind AS 116 ensures transparency by requiring companies to recognize almost all lease on their balance sheet. This shift provides stakeholders, investors, regulators, and creditors a clear picture of financial commitments and improve cross-order comparability. Ind AS 116 replaces Ind AS 17, aligning Indian standard with global IFRS practices. The key changes: lessees must recognize the right of use assets and lease liability, eliminating the distinction between operating and finance leases. The key differences between Ind AS 17 and Ind AS 116 are: lease classification under Ind AS 116 follows a more transparent approach, with most leases now being recognized. Key classification include operating leases, previously off-balance sheet items now accounted as right-of-use assets and lease liabilities. Finance leases, recognized on the balance sheet date, reflected economic substance. Lease classification criteria: ownership transfer, lease term, and present value of the payments determined classifications. Under Ind AS 116, lessees must recognize a lease liability for the present value of future payments and corresponding right-of-use assets, and thereafter subsequently adjustments ensure financial accuracy. Initial recognition relates to lease liability, which is equal to present value of lease payments. Right-of-use assets, which is equal to adjusted for initial cost and incentives. Then subsequent measurements are related to lease liability, use the effective interest rate method. Right-of-use assets are amortized over the lease term. Impairment tests ensure assets value remain realistic. Two critical aspects in lease accounting under Ind AS 116 are: lease term includes non-cancelable period, renewals, and terminations that are reasonably certain. Second, discount rate, the implicit rate of lease or lessee's incremental rate of borrowings determines lease liability valuation. In the aviation industry, aircraft are typically leased rather than purchased due to high capital cost. Under Ind AS 116, operated leases were off-balance sheet items showing only lease expenses. Now, Ind AS 116 require airlines to recognize aircraft leases as right-of-use assets and lease liabilities. Now, its impact on financial statement is higher assets and liabilities on balance sheet, increased EBITDA as lease expense are reclassified as depreciation, and interest changes in leverage ratios. Affecting debt covenants. For example, Indigo Airlines, one of India's largest carrier, has fleet under leases. With Ind AS 116, these leases now appear as right-of-use assets and impacting financial ratios. With this, they are impacting investor perceptions. Retail and e-commerce companies such as Amazon and Flipkart now relying on leased warehouse for their distribution. Under Ind AS 116, these warehouse leases must be recorded as right-of-use assets and lease liabilities. Now, this has many implications such as higher total asset on the balance sheet, EBITDA improvement due to expense reclassification, need for effective lease remeasurement for rent escalation and contract renewals. For example, Reliance Retail leases multiple warehouses across India. After adopting Ind AS 116, these leases now appear in the financial statement, affecting their leverage ratio and financial planning strategies. Ind AS 116 has completely changed lease accounting, enhancing financial transparency and impacting financial metrics. Whether in aviation, retail, or in any other industry, mastering lease accounting isn't just about compliance, it's a big business advantage.